The S&P 500 had a strong day, up 0.75%. This came off the bat in strong gains in the material sector, information technology, and consumer discretionary. Although energy, as well as utilities, struggled on the day, as well as healthcare. The Nasdaq performed even better, up 1.39%. In the Canadian markets, the S&P TSX Composite was up 0.79%, with strong gains in information technology and the consumer discretionary sector. On the losing side, the healthcare sector was down. On the other hand, in Europe, the FTSE had a really rough day, falling 1.7%. In Asia, the Nikkei was flat. Oil was slightly up on the day, and gold was flat. In terms of treasuries, the US 10-year had a wild day. It started off the day up a few basis points, but actually ended down 2 basis points at 0.68%. In the currency markets, the winners were the Chinese yuan and the US dollar and the British pound. The losers were the Canadian dollar and the euro. News surrounding the housing market and how it's heating up, with July's numbers coming out strong, with home ownership, new purchases, even above pre-pandemic levels. It's interesting to think about why the housing market is doing so well when you consider that over 10% of people are unemployed. A lot of people don't have much money. You look at GDP, how much it's shrunk. At the same time, housing market seems to be doing well with prices increasing. It doesn't quite seem to add up. There could be like many different scenarios, but one I'd like to discuss is how the Federal Reserve is actually affecting the housing markets. So this article talks about how the Federal Reserve has currently purchased $1 trillion worth of mortgage bonds since March. They purchased $300 billion in March and in April, and then about $100 billion each month since then. This has caused the mortgage rate to drop. It says here it's fallen down to 2.91%, down from 3.3% in February. At this rate, they will reach $1.4 trillion in mortgage bonds purchased for this year. That's a pretty significant number. They're currently at 30% of owning the market, and that'll be up to 34%. So when you look at the Fed essentially owning 34% of mortgage bonds markets, that's a pretty significant number, and just shows you how much effect that they can actually have on the market. You might be wondering where all this money is. This basically comes from quantitative easing. Essentially means they print money to purchase these bonds. So you'll see probably some inflation effects coming at some points. But talking more into the housing market scenario, what this does is it allows essentially banks to continue to provide mortgages, as they know if the Fed continues to purchase them, that they will continue to be able to give people mortgages. As what a mortgage bond is essentially pools mortgages together to diversify them to reduce losses, and then the bank sells that as a bond to some investor. So it removes the risk, essentially most of the risk that the bank has from having mortgages, and then they get a slight spread. So in a way, it's pretty good money for the bank. It works out well for the bank, but it's a strange situation going on, and I think it's having a significant effect on the housing market going forward. Because really, with employment so high and everything going on, it just doesn't quite add up in my mind as to why the housing market is doing so well. You could look at evictions not being allowed, as that will provide an issue with supply, where people aren't essentially losing their homes and those homes going out for sale. So that will have part of it. But then you have to ask yourself, who are these people that are purchasing homes, first-time home buyers and things like that, to adding to that market, and who has the money to continue to spend more money? Well, yes, the rates are going down, and as you can see here, that is partially due to the Fed. It'll be interesting to watch how this plays out going into the future. Will house prices be able to keep this momentum? Or once we start seeing evictions, you might start seeing a bubble, maybe even the bubble popping. I'm not talking about anything like 2018, but some sort of issues in the housing market could happen in the coming years. Talking about rates, this article is pretty interesting, just going over some of the Fed stuff that they announced with inflation and how that's going to affect yields going forward. Many bond watchers are expecting that yield curves will start to increase and the yield curve will start to steepen, as we've seen that actually happen in the past week with the 10-year Treasury yield going up a decent amount. It's about roughly 13 basis points, I think, from a few weeks ago. It's a decent jump when you consider how low it currently is. But what some people are thinking is that with the US Federal Reserves talking about how they're going to let inflation essentially go above 2%, doing their weird average inflation over whatever period they want. I don't know why they don't just say that they're just going to let inflation run high, because that's essentially what they mean. Because when you use an average like that, unless you have strict definition, you essentially can force it to be whatever you want. So Fed's just basically saying that they're going to increase inflation, let inflation go high. I think this is probably just understandable, I guess, as especially with all the money they're printing, especially when it's just talking about how much quantitative easing they're doing just in the mortgage markets. That is going to cause inflation down the road, and they won't want to increase rates, as that will stifle the economic recovery, I guess, in the next coming years. But it'll be interesting to watch how high the 5 to 30-year Treasury yields will start to increase, as they have been slowly going up. Looking at US construction, it was up 0.1% in July. That's pretty good after a negative month in June of negative 0.5%. This came out of a strong growth in the residential with 2.1% increase, while the non-residential construction fell by 1%. The government's construction also fell by 1.3%, understandably given the certain conditions. Manufacturing in the United States for August numbers have come out, with factory activity increasing to 56, above July's 54.2. This is the data that comes from the supply management. It's essentially a reading that averages at 50. So 50 is essentially kind of the zero mark. Above 50 means expansion, below 50 means contraction. So high number there coming out, with the expectations from economists being at 54.8. Also, the Purchasing Managers Group's measures of orders was also up 6 points. It's actually the highest level since 2004. They've also seen some decrease in inventory, as well as some jobs. The jobs part I thought was kind of interesting. So they are still laying people off, I guess, in manufacturing. So it's kind of strange to see this improvement at the same time they're laying off. So it says here the ISM's index of factory inventories fell to 44 in August, the lowest since January 2014, indicating stockpiles were declining at a faster pace. The manufacturers for Europe also came out, with PMI being at 51.7, which is actually down from 51.8 in July. They have much similarities between the United States, actually, with notable cutting of jobs that happened, and as well as inventory being lower. One interesting part about this is that there is a change in Germany's outlook for the future, as they now expect only a contraction this year of 5.8% in GDP, compared to their previous of negative 6.3%. Although they are planning on not having quite as much growth in the coming year, due to not having so much lost this year. I thought this article made some interesting points and took a pretty good look at unemployment in Europe. So you might have seen the difference between the unemployment rate across Europe and in the United States, and how much higher it is in the United States. As in July, the unemployment rate was 7.9%, up from 7.7% in June. While it seems low, a lot of that has to do with the government bailing people's jobs out, supporting people's jobs, essentially paying their wages. But given that aside, in the slightly lower unemployment, it's expected to get worse, as many expect that unemployment will see another wave of layoffs, as it will continue to increase by the end of year and into next year. This is even with the European Central Bank is currently printing money, and they've pumping 1.3 trillion euros, it says here, which is $1.6 trillion into the economy. And they're doing that through quantitative easing, through bond purchases.